Central banks say they fight inflation to protect you. But what if inflation is actually designed to transfer your wealth to them? Everyone knows the official story. Central banks monitor price levels, adjust interest rates, and manage monetary policy to maintain price stability for the good of the economy. But if they're really protecting you, why do your savings lose value while asset prices soar? When inflation rises, they take action to bring it back down to protect consumers from rising prices and preserve purchasing power. But there's something that doesn't quite add up. Why do asset prices keep inflating while central banks claim to be fighting inflation? Why do the wealthy get richer during inflationary periods while working people get poorer? The inflation game works by using different measures of inflation for different purposes. While central banks focus on consumer prices that affect working people, they simultaneously inflate asset prices that benefit wealth holders. This creates a wealth transfer mechanism disguised as economic policy. If this kind of monetary manipulation disguised as public service interests, subscribe to Prof. Zhang Explained and share this video with someone who's confused about why their savings lose value while billionaires get richer during inflation. They need to understand the game being played with their money. The system creates two completely different experiences of inflation depending on your relationship to assets versus labor. When central bankers talk about managing inflation, they mean different things for different economic classes. For working people, inflation means rising costs of necessities: food, housing, energy, healthcare. These price increases directly reduce their purchasing power and standard of living. Central banks monitor these prices and claim to fight inflation when they become too burdensome. For asset holders, inflation means rising values of stocks, real estate, commodities, and other investments. These price increases directly increase their wealth and net worth. Central banks facilitate this asset inflation through monetary policy while claiming to manage overall price stability. Think about the last time you heard a central bank official explain how their policies affect different types of prices differently. This explains something curious about modern monetary policy. The same actions that supposedly fight consumer inflation often fuel asset inflation. Interest rate cuts reduce consumer borrowing costs, but increase asset valuations. Money printing increases consumer prices, but inflates financial markets even more. The difference isn't accidental. It creates fundamentally different relationships with monetary policy. Working people experience inflation as a cost. Asset holders experience inflation as a benefit. But here's where it gets interesting. The inflation game doesn't just redistribute wealth from workers to asset holders. It actually changes the rules about what counts as inflation and what doesn't. Consumer price inflation gets measured, monitored, and managed because it creates political pressure. When food and housing costs rise rapidly, people demand action from their representatives. This makes consumer inflation politically costly for central banks to ignore. Asset price inflation rarely gets the same attention because it benefits people with political influence rather than creating pressure for policy changes. When stock markets or real estate values double, this is often celebrated as economic growth rather than criticized as inflation. This selective attention to different types of inflation allows central banks to appear concerned about price stability while facilitating massive price increases in asset categories that most people don't own. The psychological appeal of this arrangement is that asset holders feel like they're benefiting from good investment decisions rather than from monetary policy that redistributes wealth in their favor. But the inflation game becomes more complex when we examine how central banks communicate about their dual mandate. Most major central banks officially aim to maintain both price stability and full employment, but these goals often conflict in ways that reveal the true priorities. When consumer price inflation rises, central banks typically respond by raising interest rates to slow economic growth and increase unemployment. This fights consumer inflation by reducing worker bargaining power and suppressing wage growth. When asset prices decline significantly, central banks typically respond by lowering interest rates to stimulate economic growth and support financial markets. This fights asset deflation by encouraging risk-taking and increasing investment demand. The asymmetric response reveals that price stability really means different things depending on whose prices are changing. Consumer price increases get fought with unemployment. Asset price decreases get fought with monetary stimulus. This dual standard creates what economists might call selective inflation targeting, where the central bank's response depends more on who is affected by the price changes than on the magnitude of the price changes themselves. Do you find yourself celebrating rising asset prices while worrying about rising consumer prices? But the inflation game becomes even more sophisticated when we examine how it handles the relationship between money creation and price increases. Central banks create new money through various mechanisms, but this new money doesn't affect all prices equally. When central banks expand the money supply, the new money typically enters the financial system first through bank lending and asset purchases. This means financial assets receive the new money before consumer goods markets do. By the time the new money affects consumer prices, asset prices have already captured much of the monetary expansion. Asset holders benefit from the early price increases while consumers eventually face the delayed price increases. This timing difference creates what economists call the Cantillon effect. Those closest to the money creation benefit most, while those furthest from it bear the costs. But this mechanism is rarely explained when central banks discuss their inflation-fighting efforts. The Cantillon effect becomes particularly pronounced during periods of quantitative easing, where central banks directly purchase financial assets with newly created money. Asset holders receive immediate benefits from these purchases, while the inflationary effects on consumer prices emerge months or years later. The inflation game also exploits different measurement methodologies for different types of inflation. Consumer price indices use specific baskets of goods and adjust for quality improvements, substitution effects, and other factors that tend to understate actual price increases. Asset price increases don't get subjected to the same measurement adjustments. When a house price doubles, it's recorded as a 100% increase rather than being adjusted for improvements or substitute housing options. This measurement asymmetry allows central banks to claim success in controlling inflation, while asset prices increase far more rapidly than the reported consumer inflation rates. Meanwhile, working people experience inflation through actual budget pressure rather than statistical calculations. They know their living costs are rising faster than the official inflation measures suggest. The measurement differences also affect policy responses. Central banks use consumer price indices to guide interest rate decisions, but these indices often lag behind asset price movements and may not capture the full extent of monetary policy effects on living costs. But there's something even more insidious about how the inflation game handles the relationship between wealth and monetary policy. It creates what economists might call inflation immunity for the wealthy and inflation vulnerability for everyone else. Wealthy individuals hold most of their wealth in assets that benefit from monetary expansion. When central banks increase money supply, these assets typically increase in value faster than consumer prices increase. This means the wealthy can maintain or increase their purchasing power even during inflationary periods because their asset values rise more than their consumption costs. Working people hold most of their wealth in wages and savings that don't automatically adjust for monetary expansion. Their income might eventually catch up to consumer price increases, but usually with significant delays that reduce their real purchasing power. This asymmetric exposure to inflation effects means the same monetary policy simultaneously enriches asset holders and impoverishes wage earners. The wealth effect of monetary policy becomes even more pronounced when we consider that asset holders often benefit from leverage during inflationary periods. Real estate investors, for example, benefit from fixed-rate debt that becomes easier to service as asset values increase. Meanwhile, workers typically experience inflation as increased debt burdens relative to their income, making credit cards and other variable-rate debt more expensive during inflationary periods. How often do you hear central bank officials explain how their policies differently affect people with different types of wealth? The inflation game also creates what we might call policy justification laundering. Central banks can pursue policies that benefit asset holders while claiming these policies serve broader economic purposes. When central banks cut interest rates to inflate asset prices, they justify this as stimulating economic growth, supporting employment, or preventing deflation. The asset price inflation becomes a side effect rather than the primary goal. When central banks resist raising interest rates despite consumer price inflation, they can claim they're supporting economic recovery or avoiding recession. The continued consumer price increases become acceptable collateral damage rather than policy failures. This justification laundering allows central banks to serve asset holder interests while maintaining public legitimacy through economic growth and stability narratives. The policy justification also exploits different time horizons for evaluating success. Asset price increases provide immediate evidence of policy effectiveness, while employment and growth benefits take longer to materialize and may never offset the consumer price inflation costs. But the inflation game becomes particularly sophisticated when we examine how it handles different time horizons for different economic classes. Monetary policy affects asset prices immediately, but affects wages and consumer prices with significant delays. Asset holders benefit from immediate monetary policy effects because financial markets respond quickly to central bank actions. They can capture gains from policy announcements before the broader economic effects materialize. Working people experience delayed monetary policy effects because wages and consumer prices adjust more slowly to monetary changes. By the time they feel the benefits of stimulative policy, asset holders have already captured most of the gains. This timing asymmetry means monetary policy systematically favors those with assets over those dependent on wages, creating a built-in wealth transfer mechanism. The timing effects also create different risk profiles for different economic classes. Asset holders can often liquidate positions quickly if monetary policy changes direction, while workers are locked into wage contracts and employment relationships that adjust slowly to policy changes. The inflation game also exploits what psychologists call salience bias in how different groups perceive monetary policy effects. Asset price increases feel like investment success rather than monetary inflation to those who benefit from them. Meanwhile, consumer price increases feel like economic hardship rather than monetary policy effects to those who experience them. This differential perception allows the same underlying monetary expansion to generate positive feelings among asset holders and negative feelings among workers. The perception gap makes it politically difficult to challenge monetary policies that create these asymmetric effects because the beneficiaries don't see themselves as benefiting from redistribution, while the losers don't necessarily understand the monetary policy origins of their economic difficulties. The salience bias also affects how different groups interpret economic news and central bank communications. Asset holders focus on financial market indicators and monetary policy signals, while workers focus on employment data and consumer price information. But perhaps the most crucial aspect of the inflation game is how it handles the relationship between financial stability and wealth concentration. Central banks justify asset price inflation as necessary for maintaining financial system stability. When asset prices decline significantly, this threatens the solvency of banks and financial institutions that hold these assets. Central banks respond with policies designed to support asset prices to prevent financial system collapse. But when consumer prices rise significantly, this doesn't threaten financial system stability in the same way. Working people can't force policy changes by threatening to collapse the financial system. This asymmetric systemic importance means central banks have strong institutional incentives to prioritize asset price stability over consumer price stability, regardless of the wealth distribution effects. The financial stability justification also creates moral hazard problems, where asset holders take excessive risks, knowing that central banks will support asset prices during downturns, while workers bear the inflation costs of this asset price support without receiving similar protection for their wages. Can you think of times when central banks prioritize preventing asset price declines over preventing consumer price increases? The inflation game also creates what economists might call expectation management asymmetries. Central banks communicate extensively about their commitment to price stability, but this communication focuses primarily on consumer prices rather than asset prices. When asset prices rise rapidly, central banks rarely express concern about asset price inflation or suggest policy changes to moderate these increases. Asset price increases are typically attributed to economic fundamentals rather than monetary policy. When consumer prices rise rapidly, central banks express concern and suggest policy responses. Consumer price increases are typically attributed to monetary factors that central bank policy can address. This asymmetric communication creates different public expectations about what central banks should and will do about different types of inflation. The expectation management allows central banks to appear responsive to inflation concerns while avoiding responsibility for the asset price inflation that benefits wealth holders. The communication strategy also affects how different groups plan for the future. Asset holders receive implicit signals that their wealth will be protected through monetary policy, while workers receive explicit warnings about the cost of consumer price inflation. But there's yet another dimension that makes the inflation game particularly effective in modern economies. Globalization has changed how monetary policy affects different types of prices in ways that benefit asset holders relative to workers. Asset markets are increasingly global, so monetary expansion in major economies inflates asset prices worldwide. Asset holders can benefit from monetary policy in any major economy regardless of their location. Labor markets remain more national and local, so monetary expansion primarily affects wages in the country where the policy occurs. Workers can't easily benefit from monetary policy in other countries This globalization asymmetry amplifies the wealth transfer effects of monetary policy because asset holders can capture benefits from global monetary expansion while workers are limited to domestic policy effects. The global dimension also allows central banks in major economies to export some of the consumer price inflation effects of their policies to other countries while retaining the asset price inflation benefits domestically. The inflation game also exploits what economists call policy coordination failures between different economic authorities. Central banks control monetary policy, but don't control fiscal, regulatory, or trade policies that affect inflation. When consumer price inflation emerges, central banks can blame fiscal deficits, regulatory constraints, or trade disruptions, rather than taking responsibility for monetary policy contributions to inflation. When asset price inflation emerges, other authorities typically don't have tools to address asset prices, leaving monetary policy as the only relevant authority. But central banks rarely use their tools to reduce asset price inflation. This policy fragmentation allows central banks to avoid responsibility for consumer price inflation while maintaining the tools most relevant for asset price inflation. But the coordination failure also means that monetary policy operates in isolation from other policies that might address the distributional consequences of inflation, allowing wealth transfer effects to persist without institutional checks. The inflation game ultimately works because it tells different groups what they want to hear while creating wealth transfer mechanisms that most people don't recognize. Asset holders hear about the importance of financial stability, economic growth, and preventing deflation. These goals justify monetary policies that increase their wealth. Workers hear about the commitment to price stability, employment support, and economic recovery. These goals seem to justify the same monetary policies even when they reduce workers' purchasing power. The system succeeds in making wealth redistribution through monetary policy seem like economically neutral, technocratic management, rather than politically consequential resource allocation. But the game requires that most people don't understand how monetary policy creates these asymmetric effects. If workers understood that asset price inflation comes at the expense of their purchasing power, they might demand different monetary policy approaches. Meanwhile, asset holders benefit from the current system, precisely because it's not widely understood as wealth redistribution, allowing them to capture benefits without political backlash. The inflation game represents one of the most successful mechanisms for transferring wealth from workers to asset holders while maintaining the appearance of economically neutral policy designed to benefit everyone. It allows central banks to serve asset holder interests while claiming to serve broader economic stability goals, ensuring that monetary policy systematically favors wealth concentration rather than broad-based prosperity. But perhaps the most remarkable aspect of the inflation game is how it's convinced people that there's only one type of inflation worth measuring and managing, when in reality, there are multiple types of inflation with very different distributional consequences. The game has successfully hidden the wealth transfer mechanisms behind technical economic language and institutional complexity, making it nearly impossible for most people to understand how monetary policy affects their economic position relative to others. Hit subscribe if you want more analysis of how economic policies that claim to serve everyone actually serve specific wealth interests, and share this with someone who's confused about why their purchasing power declines while asset prices soar.